Thank you for choosing StartEngine, a platform dedicated to helping entrepreneurs achieve their dreams. In order for your company to raise money on StartEngine, you need to submit your campaign to the StartEngine review. This presentation is to give you a brief overview of the StartEngine review process, how it works, and go over some of the most frequently asked questions we receive from companies in this process. First, we're going to cover what the review is exactly. Then we're going to explain the process, and finally we're going to go over some of the most common questions we receive from companies in this process, and hopefully this will answer any questions you might have. So what is the StartEngine review? Because you're raising money from the crowd, your campaign is regulated by SEC rules. As the platform hosting your campaign, we're responsible for making sure that it's compliant with those rules. In order to do that, we've set up the onboarding to streamline the collection of information that you're required to provide to the SEC and your investors. The review process makes sure that you've included all that information and that everything you've included is accurate to the best of your and our knowledge. So how does the process work? The first step is to complete the onboarding of your campaign to the fullest extent possible. If you're missing any of the required information, you'll be prevented from hitting the submit button. Once you're able to hit the submit button and your campaign is complete, the StartEngine review team aims to have feedback provided to you within 48 hours. The review team goes through all the information provided throughout your campaign to make sure that it's accurate, complete, and compliant. If it is, you will receive an email saying you're approved. If there's some work to be done, you'll receive an email from StartEngine review team within a 48-hour window explaining the different issues that need to be addressed. Don't worry, if there are still things to be fixed, we have a lot of resources available to help. We offer weekly Q&A live streams, standard customer service channels like live chat and email, and an extremely robust FAQ. Once you think you've addressed all the comments, you click the submit button again, prompting the diligence team to review the campaign because you've made all the changes that are required. So now that you understand the process, here are a couple tips to some of the most frequently asked questions. This is a brief summary of the top 5, but we'll just dive right into number 1. One of the most common questions we get is what are the different types of offerings available to my company? This generally falls into 2 main categories. 1, equity, and 2, convertible notes. Our most common type of offering is still equity. Generally, that's broken down into a couple different criteria. First, if you're a C Corp, it generally breaks down into 2 types. We classify this kind of as common stock and then other. Common stock is used by a lot of companies because it's simple, it's understood by investors, and it's very easy to implement. Everything else for a C Corp falls under other. This includes things like multiple classes of common stock or preferred stock. If you fall into the other category, these classes of stock need to be established by your articles of incorporation. The reason companies choose to use this type, even though there's a bit more corporate governance involved, is generally either to make the offer more attractive to investors or to provide additional protections to the company. Some examples of this can be forms of liquidation preference or voting rights. It all varies depending on what the company is trying to achieve, and again, they have to be established in the Articles of Incorporation. If you're an LLC, the classifications again are somewhat similar. Generally, equity offerings for an LLC will fall under membership units or other. Again, anything that's other besides standard membership units, the rights have to be created by the company's operating agreement. Any LLC offering equity should also be manager managed and issue ownership through units instead of percentage. The reason for this is in order to work through the platform and plan for the possibility of a scenario where you have 100+ members in your company. The second type of equity that's most common is a convertible note. So what's a convertible note exactly? It's a debt instrument that gives investors the right to receive equity in the company in a future offering. So in exchange for putting in money before the company sells equity in an equity round, the investor gets to pay a discounted price when the company does raise that equity round down the line. So for example, if the company charges $1 per share when they do raise an equity round, and the investor gets a 20% discount rate for investing in the convertible note, the investor will only pay 80 cents per share if they have this convertible note. The reason a company uses convertible notes typically is 1, because it's much simpler to achieve. It doesn't require a lot of corporate structural change or compliance, and it's generally a bit quicker since you don't have to negotiate terms or evaluation, so it's much easier to set up. Another question that we frequently get is what the requirements are for the information companies put on their story page. This is the main section investors see when they're looking at your campaign. Generally, we leave this information on the story page up to companies to keep their story compelling, but there are a couple of guidelines. One, stats, facts, and graphs are great, but all require a source. You can do this through hyperlinks or footnotes. Two, statements of opinion and prediction need to be qualified as such. For example, you can say, you can't say you will become a market leader. Instead, you can say you believe that you're positioned to become a market leader down the line. Third, statements about IP need to be verified. This includes anything about trademarks, patents, things like that, material contracts. And generally, we can accept any method that will allow us to verify the validity of the comment. But typically, this is done by emailing something like the USPTO filing number or the actual patent filing to compliance@startengine.com. And finally, any statements that you want to include in the story section about future returns are required to be supported by detailed information or removed. So what this means is an example would be a full business plan or full-fledged financial projections if you want to discuss any sort of financial returns you expect your company might make down the line. This essentially is to substantiate that the figures are based on real calculations as opposed to pulled out of thin air. The third most common question we get is, what information do I need to include on the team page? So while it's generally up to you whether or not to include many of the members on your team, there are a couple that are required. You're required to include all of the following: executive board members and any other officers of the company that are participating in the offering, and any members of your board of directors, or if you're an LLC, any managing members. And then for anyone who falls under these criteria or any greater than 20% shareholders, you're required to include the following information listed at the bottom of this page, which includes your entire work history for the past 3 years with this company and any others. And included in that information, you have to have the name and principal business of the company, the title that you held, and the dates that you served under each title. And something important to note here that a lot of companies seem to forget is that the dates served includes with the current company that you're raising money for. Okay, so fourth, a lot of companies ask, how do I calculate my pre-money valuation? So the way this calculation is supposed to work is that your pre-money valuation equals your total amount of issued shares on a fully diluted basis times the price per share in your offering. Fully diluted, just to give a brief recap, means that this includes any shares that are granted to anyone, whether they're vested or not. So an example of this calculation, very simple basic math, is that a company that has 5 million shares of common stock issued that wants to do their raise at $1 per share in this offering, their pre-money valuation is 5 million shares times $1 per share equals a $5 million pre-money valuation. So that's a very frequent question, and just remember when you're setting these numbers, the pre-money valuation and the price per share are tied together. So make sure the calculation ties back for both of those numbers. The fifth most common question we get, very complex part of the onboarding, is on the legal page, and it's discussing what goes into your classes of securities outstanding page. Essentially, this is the section that identifies every class of security that exists in your company and explains the difference between them. It gives investors a better understanding of how their investment plays into the bigger picture. And generally, if a company has more than one class of security, you have to use the Add Another Class of Security Outstanding button at the bottom of this field for each additional class. So for example, generally companies, C Corps will default to having at least one class of common stock, and LLCs will have either membership interests or units. This is dictated by either your articles of incorporation or your operating agreement. If you have anything else outlined in your articles of incorporation, for example, a multiple classes of common stock or common stock and preferred stock, each of these would need you to add another class of securities outstanding to this section. And this includes classes that have been authorized in your articles of incorporation, even if no shares have been issued, just to give investors an understanding of where their investment falls into your corporate structure so that somewhere down the line they are aware they might be diluted. So continuing on in this section, there are 3 key pieces of information that are included in each field. The first is a security name. This should be a specific and exact type of security and should match exactly what's listed in your articles of incorporation or your operating agreement. So if it says common stock or it doesn't designate in your articles of incorporation, it's common stock. If you have Series A preferred stock, it should say Series A preferred stock. It should match exactly what's in your articles. The second piece is the outstanding amount of securities in this class. This number goes to the right of the security name. And this is an issue of a lot of confusion generally. What's supposed to be in this field is the amount of shares issued. A lot of companies get this confused with the amount authorized. Issued means the amount of shares that are actually owned by someone in the company. And this is calculated on a fully diluted basis, again, meaning even if they've been granted to someone and have not yet vested, they should be included in this section. The third field in this section is the description of rights and preferences. This is a longer description of the different preferences of each class of security. This is more of an in-depth discussion of each security type, but should include information that reflects what's broken down either in your articles of incorporation or operating agreement or by state law if you have not set specific rights and privileges in your operating agreement or articles. So for example, for equity, it would include things like voting rights, dividend or distribution rights, liquidation preferences, dilution possibilities, and any other material terms. For convertible notes, this would include things like the equity the notes convert into, the conversion trigger, the valuation cap, the discount rate, total amount invested, and any other material terms. Now we're going to go down into some of the other top 10 questions. This is 6 through 10. We'll just dive right in. The risk section. This section is on the legal tab, and a lot of companies are unclear on what it's for. So just to clarify, the risk section is meant to include disclosures specific to the company and serves two major purposes. It informs investors of the various risks that the company faces, allowing them to make a more informed decision, but it also is intended to mitigate risk of liability for the company to shareholders in the event that any of these risks come to pass. So essentially it acts as defense in the future in the event of shareholder litigation if any of these risks should come to pass. In consideration of this, we strongly suggest companies make it very specific and as detailed as possible and brainstorm any risks that they can foresee that are specific to their company and absolutely include anything that falls under that category in this discussion. Another important note is that this should just disclose the risks and not include any sort of mitigation strategies that may tie the company to using in the future. Just disclose the risks as they are bare so that companies are aware that the company faces them. Moving on from the legal tab, another section we see a lot of questions is the financial tab. The first section we see a lot of questions is regarding the financial statements and what needs to be included. So essentially, the SEC requires the following statements for all companies for the past 2 years or if shorter since the date of inception. So those 5 statements are the balance sheet, income statement, statement of cash flow, statement of changes in equity, and then notes to those financial statements. And then there's 3 different thresholds for the level of preparation. Anything for $107,000 or less raised must be certified by the principal executive officer of the company. Anything from $107,000 to $535,000 must be reviewed by a public accountant that is independent of the issuer and must include a signed review report. Anything above $535,000 up to the maximum amount of $1,070,000 that falls under 2 categories. If the company has not previously used regulation crowdfunding and is offering from $535,000 to $1.7 million, financial statements must be reviewed by a public accountant independent of the issuer and include a signed review report. If they have previously used regulation crowdfunding, financial statements have to actually be audited by a public accountant, and they have to be independent and include a signed audit report. The difference between these is that the review report is a lesser threshold of scrutiny for the auditors and thus cheaper for the companies to order when doing the offering. It's a magnitude of possibly up to 5 times the cost of a review report for a full audit. And then moving on from the financial statements into the financial condition of the company, we see a lot of questions here, specifically with regards to the discussions about the financials. The first question we see, what should I talk about in the results of operations on the financial page? This section should include detailed historical results of operations, including expenses, cost of goods sold, or any other notable details for each year, and then a discussion of whether these historical results and cash flows are representative of what investors should expect in the future. So if you have an upfront one-time expense that caused your negative income to be very high, then you would say, for example, in this year we were paying upfront for technology development, and it's not a recurring expense, so we won't have that cost in the future. If your company has no operating history, the discussion should focus on how long you can operate the business without revenue generation and what major expenses are those projections based on. The second question we receive in the financial highlights section is, what should I talk about for financial milestones? This section generally discusses future projections of the company, but should also explain those projections in very specific terms and discuss how you intend to reach those goals. So for example, if you're projecting revenues 3 years out, you have to explain the underlying calculations for those revenue projections that are based on a reasonable basis. Again, we just want to verify that you're not pulling these numbers out of thin air and you've put some thought into these so that investors understand where you're coming from. This section should also discuss any major milestones in the past as well as future milestones that impact the company, such as other future capital raising events that you've already anticipated, performance benchmark that are going to impact growth, or revenue events like going live or expanding to new territories, that kind of thing. The final question we encounter frequently in the financial highlights section is what is supposed to be in the Liquidity and Capital Resources section. So for liquidity, you should discuss how the proceeds from the offering will affect the company's liquidity and whether receiving these funds or any other funds is necessary to the viability of your business, how quickly the company anticipates using the cash, and taking into account other sources of capital the company currently has or other anticipated sources of capital. Kind of overlapping with that, the capital resources section of this disclosure is referring to describing the sources of capital that the business has available to it currently, or any contemplated capital resources that the company has anticipated in the short and long term, such as other types of debt, contributions by shareholders, future rounds of fundraising that are anticipated, bank lines of credit that may be discussed already, anything essentially related to the money that the company has on hand or has access to in the near or short term in a realistic manner. So those are some of the top 10 most frequently asked questions we get. Hopefully that can get you through most of it. If you're just getting stuck and you want to discuss the StartEngine premium package, we're happy to help you overcome some of these hurdles with more specific and customized services that will help put together your campaign, which can be communicated through hello@startengine.com.